Car dealerships are in full-blown panic mode. Just a few years ago, they were untouchable, charging sky-high prices and making record profits. But now, lots are overflowing with unsold cars. Prices are crashing. Buyers are walking away. And here's the shocking part. This could be your best chance in over a decade to get an insane deal on a car. But this window of opportunity won't last forever. So what's happening? Why are dealerships drowning in inventory? Which brands are hurting the most? And more importantly, how can you take advantage of this collapse to save thousands? Let's get into it. What's happening? If you walked into a dealership in the early 2020s, you were met with sky-high prices, empty lots, and salespeople who knew they had all the power. The reason? A global supply chain crisis that flipped the entire auto industry on its head. When the pandemic hit, factories shut down, and critical components like semiconductors became scarce. With fewer cars being produced, dealerships found themselves with limited inventory. But instead of keeping prices reasonable, they saw an opportunity. They jacked up prices, added market adjustments, and forced buyers into bidding wars just to secure a vehicle. Buyers had no choice. Many needed a car urgently due to work, relocation, or changes in lifestyle. Others believed the hype that prices would never go down, and that buying sooner was better than waiting. Some vehicles, like pickup trucks and SUVs, were selling for $10,000 or more over the manufacturer's suggested retail price. Even economy cars were being marked up, forcing buyers to pay thousands over sticker price just to get something on the road. But as with every financial bubble, what goes up must come down. The problem was simple. Dealerships got used to easy money. They believed the high demand would last forever, but they didn't account for what would happen when production ramped back up. The era of dealership dominance was already setting itself up for collapse. As automakers tried to catch up to demand, they made a critical mistake, one that would leave dealerships drowning in unsold cars: the overproduction gamble. After 2 years of supply shortages, automakers were desperate to recover lost profits. The solution seemed simple: build more cars, flood the market, and sell at record-high prices. They assumed that demand would remain strong and that people would continue paying outrageous prices. Factories started running at full speed again, churning out vehicles at a pace not seen since before the pandemic. Car companies ordered millions of semiconductors, expanded production lines, and pushed out as many vehicles as possible to meet what they believed was never-ending demand. But something changed. By the time these new vehicles hit dealership lots, consumer demand had already collapsed. Buyers were no longer in a rush. Many had already overpaid for vehicles in the previous years and were now stuck with massive car loans. Others were simply unwilling to pay inflated prices when the economy was showing signs of slowing down. The result? Overflowing dealership lots with cars nobody wanted. Brand new vehicles, especially expensive ones like full-size pickup trucks and luxury SUVs, were sitting for weeks, then months, without a buyer. Parking lots filled up so much that some dealers had to rent extra storage space just to hold unsold inventory. Even worse, manufacturers kept pushing more cars onto dealers despite the lack of buyers. See, dealerships don't get to control how many vehicles they receive. Automakers send inventory, whether they like it or not. This meant that dealers had no choice but to keep taking shipments of unsold cars, hoping for a turnaround that never came. By the time dealerships realized what was happening, it was too late. The market was oversaturated, demand had collapsed, and interest rates were about to make things even worse. It wasn't just the surplus of cars keeping buyers away. Financing a vehicle had become a financial nightmare. The financing nightmare. Even if a buyer wanted a new car, there was one major obstacle: interest rates had skyrocketed. During the pandemic, the government kept interest rates low to stimulate spending. This meant car loans were cheap, with many buyers securing 0% financing or rates below 3%. But as inflation surged, the Federal Reserve hiked interest rates aggressively, causing auto loan rates to jump to levels not seen in over 2 decades. By 2024, the average interest rate on a new car loan had climbed to over 7%, with some buyers being offered rates as high as 10 or 12%. This meant that even if a car's sticker price was the same, the cost of borrowing had drastically increased the total amount a buyer would pay over time. To make things worse, dealerships pushed longer loan terms to make monthly payments seem affordable. Instead of traditional 60-month loans, many buyers were being offered 72 or even 84-month financing plans. That's 7 years of payments on a vehicle that depreciates the moment it leaves the lot. For buyers, the numbers simply didn't add up anymore. Taking out a massive loan for a vehicle that might be worth half its value in a few years was no longer an appealing option. Many consumers started looking at the big picture. Was a new car really worth this kind of financial risk? As a result, buyers started backing away from dealerships in droves. They chose to hold on to their current vehicles longer, avoid new loans, or look for alternative transportation options. Suddenly, the car market that had been booming just a year before was grinding to a halt. With demand crashing and financing becoming impossible, dealerships were left with no choice. They had to start slashing prices to survive. From desperation to discounts. When dealerships were making record profits, they had no incentive to lower prices. But now, with inventory sitting unsold for months, the game had changed. Dealers are desperate to move vehicles, and the only way to do that is by offering massive discounts. In some cases, dealerships are cutting $10,000, $15,000, or even $20,000 off the sticker price just to get a sale. Some of the biggest discounts are hitting full-size trucks and SUVs, vehicles that were once the most profitable models on the market. The Ford F-Series, Chevrolet Silverado, and Ram 1500 are seeing the deepest price cuts as demand for these high-cost vehicles plummets. Even luxury brands, which previously thrived on exclusivity, are slashing prices to attract buyers. The Cadillac Escalade, Lincoln Navigator, and high-end trims of the Jeep Grand Wagoneer are all sitting unsold on lots, forcing dealers to offer incentives they never planned to give. To make matters worse for dealerships, buyers are still waiting. Many shoppers expect prices to drop even further, refusing to buy now when they believe better deals are just months away. The result? A car market that went from extreme greed to extreme desperation in just a few short years. With dealerships struggling, buyers finally have the upper hand. But why are so many people still refusing to buy? The revenge of the buyer. During the peak of the pandemic-era car shortage, buyers were at the mercy of dealerships that demanded outrageous markups. Even base-model cars were selling for thousands over sticker price, and popular models like the Ford Bronco or Toyota Tacoma were marked up by as much as $10,000 or more. Dealers justified these prices by blaming supply chain issues and a lack of inventory. But behind the scenes, they were making record-breaking profits at the expense of desperate consumers. Now, as dealership lots fill up with unsold inventory, those same buyers are walking away. Shoppers are no longer willing to pay overinflated prices, and dealers who once had waiting lists for new cars are now begging customers to make a purchase. The power has shifted, and buyers know it. Instead of jumping at the first discount they see, they are waiting for prices to drop even further. They understand that as inventory continues to pile up, dealerships will be forced to cut prices even more. This new wave of buyer resistance is causing a ripple effect across the industry. Dealerships that once turned away customers who refused to pay a markup are now desperately calling back leads, offering better deals, and trying to salvage sales. But for many buyers, it is too little, too late. The industry spent years exploiting consumers, and now those same consumers are holding out for revenge. The used car market meltdown. The drop in new car prices is not just affecting dealerships, it is wreaking havoc on the used car market as well. For years, used cars were seen as a smart alternative to overpriced new vehicles. Demand for pre-owned models surged during the pandemic, causing used car values to skyrocket. In some cases, lightly used vehicles were selling for more than their brand new counterparts. But that was then. Today, the situation has completely reversed. As new car prices fall, used car values are crashing. Trade-in values have dropped by 20% or more, leaving many car owners stuck with negative equity. This means that the car they bought just a year or two ago is now worth significantly less than what they still owe on their loan. This is especially devastating for buyers who purchased vehicles at peak pricing during the supply chain crisis. Many of them financed their cars with long-term loans at high interest rates, assuming that the market would remain stable. But with prices tumbling, these owners now face the harsh reality that their vehicles are depreciating faster than they can pay them off. Even worse, the flood of repossessed vehicles is adding to the problem. Many buyers who overextended themselves on expensive car loans are now defaulting on payments, leading to record-high repossession rates. These repossessed vehicles are being sent to auctions, further increasing the supply of used cars and driving values even lower. For dealerships, this is a nightmare scenario. A year ago, they were selling used cars at enormous markups. Now they are struggling to offload pre-owned inventory without taking huge losses. Some dealers are offering massive discounts on used vehicles, but many consumers are still hesitant to buy, knowing that prices could continue to fall. For car owners looking to trade in their vehicle, the timing could not be worse. Dealerships are offering rock-bottom prices for trade-ins, knowing that they will struggle to resell them for a profit. This leaves many drivers with a difficult choice: either accept a huge financial loss on their current car or hold on to it and hope the market stabilizes. The true cost of ownership. With car prices in free fall, you might expect more people to start buying, but instead, many consumers are choosing to keep their current vehicles for as long as possible. Why? Because the overall cost of car ownership has never been higher. One of the biggest factors is insurance costs. Over the past few years, car insurance premiums have skyrocketed, adding hundreds of dollars to the cost of owning a vehicle. Even buyers who find a good deal on a new car may be shocked to discover that their insurance rates make the purchase unaffordable. Some states have seen insurance rates double in just a few years, making it a major financial burden for drivers. Maintenance and repair costs have also surged. Newer vehicles, especially those with complex electronics and turbocharged engines, often require expensive repairs and specialized parts. Many buyers are realizing that owning a brand new vehicle comes with hidden costs that dealerships do not mention. Because of these rising expenses, many car owners are holding on to their vehicles longer than ever before. The average age of a car on the road today is over 12 years, and that number is climbing. Instead of trading in for a newer model, more drivers are investing in repairs and maintenance to keep their cars running for as long as possible. Another reason people are reluctant to buy is economic uncertainty. With rising inflation, high interest rates, and fears of a potential recession, many consumers are prioritizing financial stability over major purchases. Buying a car is a long-term commitment, and in today's unpredictable economy, many people simply do not want to take on more debt. The rise of alternative buying strategies. As dealerships struggle to adapt, many consumers are finding new ways to buy cars without dealing with traditional dealers. The old model of walking into a dealership, haggling with a salesperson, and hoping for a fair deal is quickly becoming outdated. One of the biggest shifts is the rise of direct-to-consumer sales. Companies like Tesla, Rivian, and Lucid have proven that buyers are willing to purchase cars online without ever stepping into a dealership. This model eliminates dealer markups, hidden fees, and high-pressure sales tactics, offering a more transparent and hassle-free experience. Seeing Tesla's success, other automakers are starting to follow suit. Ford and General Motors have both hinted at scaling back their dealership networks and exploring more direct sales models. If this trend continues, traditional dealerships could become obsolete. Another growing trend is online car marketplaces. Websites like Carvana, Vroom, and Cars.com allow buyers to shop for vehicles from the comfort of their homes, compare prices across multiple sellers, and even have cars delivered directly to their door. These platforms offer more transparency than dealerships, making it easier for buyers to find the best deals without the hassle of in-person negotiations. Some buyers are even importing vehicles from other countries to bypass dealership markups. In certain markets, importing a car can be cheaper than buying locally, even after factoring in taxes and shipping costs. This strategy is becoming especially popular for electric vehicles and high-demand models that are overpriced in the United States. As more consumers explore these alternative buying methods, dealerships are losing their grip on the market. The days of dealers holding all the power are quickly fading, and buyers are taking control of the car buying process like never before. It's not just gas-powered cars that aren't selling. Dealerships are stuck with thousands of electric vehicles that no one wants. The EV market slowdown. Not long ago, electric vehicles were supposed to be the future of the auto industry. Automakers rushed to produce more EVs, investing billions of dollars into research, development, and manufacturing. The assumption was simple. Buyers wanted to move away from gas-powered cars, and the demand for EVs would continue to rise indefinitely. But now, that assumption is proving to be a major miscalculation. Across the country, dealership lots are overflowing with unsold electric vehicles. Despite generous tax credits and aggressive marketing campaigns, EV sales are slowing down significantly. Consumers who were once excited about the transition to electric cars are now hesitant, questioning whether EVs are truly the best option. The reality is that the EV market is experiencing growing pains that automakers didn't anticipate. One of the biggest obstacles is battery technology itself. While EVs promise lower maintenance and fuel costs, buyers are still concerned about battery longevity, performance in extreme temperatures, and the high cost of replacement. Unlike gas-powered vehicles, where engine repairs can be spaced out over decades, EV owners are facing an expensive battery swap within a decade or less. This has led many to question the long-term value of their investment. Additionally, the aggressive production of EVs has created a supply-demand imbalance. With more models hitting the market than buyers willing to purchase them, dealerships are struggling to move inventory. The dream of endless EV demand is now collapsing under the weight of reality. Even for those who are open to buying an electric vehicle, one major issue remains. Charging infrastructure is still years behind where it needs to be. These infrastructure issues are making buyers hesitate. Until the U.S. develops a reliable, widespread charging network that rivals the accessibility of gas stations, many potential EV buyers will stick with traditional vehicles. Automakers assume that buyers would overlook these challenges, but reality has proven otherwise. The rapid depreciation of EVs. Even those who have already purchased an EV are facing a new problem: plummeting resale values. Unlike traditional gas-powered cars, which can hold value for years, many electric vehicles are depreciating at an alarming rate. In some cases, certain models are losing 50% or more of their value within just a few years. This is happening for several reasons. First, battery technology is evolving too quickly. Newer EV models are constantly improving, offering better range, faster charging, and more efficient power management. This means that older models become obsolete much faster than gas-powered vehicles, where changes between generations are more incremental. Buyers looking for an EV would rather purchase the latest model than settle for a car with outdated battery technology. Second, many early EV adopters paid a premium price when demand was high. Now that supply has caught up and demand has softened, used EV prices have tanked. Those who financed their cars during the peak pricing period are now trapped in underwater loans, owing far more than their car is worth. Some owners are even choosing to default on their loans rather than keep paying for a rapidly depreciating asset. Finally, uncertainty about battery replacement costs is driving resale values down. Unlike gas-powered vehicles, where an engine repair might cost a few $1,000s, EV battery replacements can cost $10,000 or more. Many used car buyers simply don't want to take the risk, preferring to buy a new EV with a full manufacturer warranty rather than gamble on a second-hand model. The result? Used EVs are piling up on dealership lots, just like their new counterparts. Instead of a thriving resale market, many dealers are slashing prices just to move inventory. Automakers scaling back. With dealerships struggling to sell electric cars, automakers are finally being forced to rethink their production strategies. For the last few years, major manufacturers bet everything on the EV transition. Companies like Ford, General Motors, and Volkswagen poured billions of dollars into new EV factories, assuming demand would only continue to grow. Now those same companies are walking back their ambitious plans. Ford has already announced production cuts for its electric vehicles, scaling back output for models like the F-150 Lightning due to weaker than expected sales. General Motors, which once promised to go fully electric by the next decade, is now delaying or canceling EV models that were planned for the near future. Even Tesla, the most successful EV company, has seen slower growth and increased price cuts as demand softens. One of the biggest challenges facing automakers is profitability. Unlike gas-powered cars, which have well-established production processes, EV manufacturing is still incredibly expensive. The high cost of batteries, the supply chain for rare minerals, and the need for new assembly plants have made EVs far less profitable than traditional cars. As a result, automakers are realizing that the EV transition won't be as fast or as smooth as they originally thought. Instead of flooding the market with new models, companies are pausing production, reassessing demand, and even shifting focus back to hybrid vehicles. This shift marks a turning point in the auto industry. For years, the message was clear: EVs were the future, and gas-powered cars were on their way out. But with demand slowing, inventory rising, and buyers hesitant to make the switch, automakers are facing the harsh reality that the transition will take much longer than expected. The end of traditional dealerships? Why the business model is in danger. For decades, dealerships controlled the car market. acting as the middlemen between automakers and consumers. They set the prices, handled the financing, and controlled the entire sales process. But today, their dominance is being challenged like never before. The rise of direct-to-consumer sales is threatening the very foundation of the dealership model. Tesla proved that car buyers do not need dealerships at all by selling directly to consumers. They eliminated the dealership markup, provided transparent pricing, and removed the high-pressure sales tactics that have frustrated buyers for years. The success of this model has forced traditional automakers to rethink their own sales strategies. Ford, General Motors, and Volkswagen are all experimenting with direct online sales, allowing customers to configure their vehicles and place orders without ever stepping foot in a dealership. Even brands like Hyundai and Toyota are testing factory direct pricing models, cutting dealerships out of the equation. The writing is on the wall. If dealerships do not adapt, they will become obsolete. The days of buyers spending hours haggling over prices in a dealership may soon be over. But while this transition benefits consumers, dealerships are not going down without a fight. The hidden costs of dealerships. Even as dealerships slash prices, they are still finding ways to squeeze extra profits from buyers. Their business model is built on making money beyond the sticker price, and they are using every trick in the book to ensure they remain profitable. One of the biggest tactics is sneaking in hidden fees, market adjustment fees, documentation fees, destination charges, and even protection packages are often added at the last minute, and many buyers do not realize they can refuse to pay them. Extended warranties are another major moneymaker for dealerships. While some warranties can be useful, many are overpriced and filled with loopholes that make them difficult to use. Dealerships aggressively push these add-ons because they bring in huge commissions. Then there's the financing trap. Many buyers assume getting an auto loan through the dealership is the best option, but dealerships often mark up interest rates to make additional profits. Even a 1% increase in interest over a long-term loan can cost a buyer thousands of dollars over the life of the loan. Another common scam is gap insurance and add-on protection plans. Dealers convince buyers that they need extra coverage for things like paint protection, tire warranties, and key replacement, often charging hundreds or even thousands of dollars for services that offer minimal value. The reality is that even when prices are falling, dealerships still find ways to extract more money from buyers. This is why consumers need to be more vigilant than ever before, carefully reviewing every charge on their final contract and being willing to walk away from unnecessary add-ons. The last stand. With their traditional business model under attack, dealerships are desperately searching for ways to stay relevant. Some are adjusting their sales strategies, while others are trying to reinvent themselves entirely. One of the most aggressive tactics dealerships are using is huge trade-in bonuses. In an attempt to bring buyers back, many dealers are offering artificially high trade-in values to make new cars seem like a better deal. However, this often comes with a catch. The higher trade-in value is offset by a higher purchase price. Dealerships are also embracing subscription-based car sales, offering customers the ability to lease a vehicle month to month with maintenance and insurance included. Some companies are betting that buyers will pay for convenience rather than ownership. While this may work for some consumers, these subscriptions often end up costing more in the long run than simply buying a car outright. Some dealers are even experimenting with no-haggle pricing models, trying to mimic the transparency of Tesla's sales approach. However, many of these dealerships still pack hidden fees into their pricing structures, making the final cost higher than advertised. Additionally, dealers are relying more heavily on service and repairs to maintain profitability. Since most new cars require little maintenance, dealerships are offering prepaid service plans, extended warranties, and exclusive loyalty programs to keep customers coming back. At the same time, automakers are pressuring dealerships to move inventory faster, forcing them to accept lower margins on new cars. This is leading some dealers to focus more on used car sales, where they have greater control over pricing and can make larger profits. The fight for survival is far from over. Dealerships know they must adapt, but the question is whether they will make changes that actually benefit consumers, or if they will simply find new ways to manipulate the market. But what do you think? Are dealerships finally paying the price for years of overpricing and manipulation, or will they find a way to survive in this new era? Let me know in the comments below.